Hi, this is David Roach from Quantum Strategy. First, let's deal with what we actually do and why it could matter to you as an investor. Quantum Strategy looks at geopolitical events and selects those events which represent a break with history. That means that the forecasting tools of mediocre minds, which is to extrapolate the past into the future, do not apply to those events. The second thing we do is to work out which events actually matter economically and to the markets, and to select those events, like putting a sharp point on a pencil. We then use that sharp point to benefit asset allocation in your portfolios. So we're not talking just about macro, we're talking about macro which represents a break with history, and we're talking about macro that matters for economics and for your portfolio. Now let's look out for a little bit. We've been through a very fortunate time for markets. What was the cause of that? Okay, the cause was very simple. It was that inflation fell, giving central banks the confidence to cut rates and reduce the cost of capital. And at the same time, as inflation fell, the economies recovered. That was a dream world. It actually was a kind of adolescent Goldilocks world, a word which I hate, but you have to apply the words you hate to the circumstances that you also think they suit. That cannot happen again. Well, it can happen again, can't it? Economies can continue to motor next year, and inflation can continue to fall. In fact, inflation probably will continue to fall. What cannot happen again is that this should surprise markets. We've had our surprise. We've had the benefits of those surprises, and we cannot repeat them. We therefore have to think next year what will drive markets. And in the main, I think it will be the bridging of a certain number of gaps in the consciousness of investors. The first of the gaps is the assumption that manufacturing production will catch up with services production, which is what has been driving the economic recovery. And the answer is it won't. And the reason it won't is because if you think of any manufactured product you buy, from a loaf of bread to an iPhone, to your modern electric bicycle, 60 or 70% of the value of that bicycle, of that phone, is now accounted for by software. It is the software content of manufacturing which is growing. It doesn't have to be simply in what you get out of the machine or out of the product. It is how the product is produced. And because the software, the intangible content of that product is so great, it means that manufacturing is on an accelerated downward trend, and the services production, which is what happens when you make software, is on a rising trend. Therefore, the gap will not be bridged. That has a number of consequences. For a start, it weighs on total growth. It will keep it lower. Second of all, it excludes those parts of the economy, including many emerging markets, from the economic recovery, because they produce the tangible part of the manufactured product you buy, but it is not that part which is growing, and they do not produce the intangible part of that product. The second gap, which people assume will be bridged and won't be bridged, is the global divergence of growth. Europe is supposed to catch up with America and therefore provide a more balanced world growth figure. The same for China. Neither will happen. Europe will not catch up with China because the heart of Europe is actually manufacturing in Germany. Manufacturing in Germany is bigger than the sum of manufacturing in France and Italy together. And to put it in the colloquial, manufacturing in Germany is screwed for two reasons. It was built on cheap energy from Russia, which was obviously one of the most stupid blunders in Germany's modern democratic history. And it was built on selling outmoded cars and machine tools to China that now produces better products and is actually challenging Germany's market share, not just in China, but around the world. The confidence factor in Germany is now so low and so contagious that it will weigh on the whole of Europe, and it will be multiplied. It will actually be enabled by the fact that both France and Germany are now paralyzed by populism or the threat of populism. So the sort of economic measures that could actually lift Europe out of this stagnation and were in the main recommended by the famous Draghi report will not be implemented because there is not the political agreement or harmony to do so. The second way in which the gap, the growth gap, will not be bridged is that China will not catch up. They may publish economic statistics that say they're growing at 5%, but the reality will be far short. To put it bluntly, China suffers from over-leverage, bad loans and bad assets, which weigh on the economy. It suffers from a corrupted real estate delivery chain, which involves local governments financing themselves at a property market at one end and consumers paying for houses which were never built at the other end. What China proposes to do for this is actually to make bad assets cheaper to finance and encourage consumers who lack all confidence to do so, to buy houses they do not need. That will not work. In fact, if you look at the measures taken by China, both by the monetary mechanism or authorities and by the Politburo, they all want to apply more central party remedies, more resources to existing problems, without actually allowing those existing problems to be dominated by the markets and therefore by the private sector. I will give you one simple example. House prices in China have fallen 10% on a year. If you look at house prices in other economies which have had the sort of crisis, the real estate crisis that China is now suffering, they usually fall 30 to 40% in the same time period. So there is no market price discovery. And therefore, private individuals will not step in to buy houses and make the economy turn around. That is simply one example of the reason why the growth gap between China and the rest of the world will not be bridged. If we then go and wrap all this up and say, well, what does this mean? You have to add one further factor, and that is the US election. I believe that both the presidential candidates are damaging in the extreme for the US economy. Trump, because he will impose tariffs and he will do what he says and raise inflation and lower global growth, nowhere greater than in the US and Europe. And Kamala Harris, because she will spend money she doesn't have in a country which is running a 6% budget deficit and which is motoring on the freeway towards having 130% of GDP as debt, which is approximately the same level as Italy, but without the national savings rate to meet it, which then brings in the role of the dollar where foreign inflows of capital is the only way of meeting it, that deficit, and which the geopolitical situation is going to make a lot less easy if China is successful in replacing the dollar in international transactions, which has not happened yet. If you take those three gaps, then I believe the next year promises a bear market. It is a bear market based on two factors. Number one, we cannot repeat the happy miracles of the last year, both in terms of interest rates and in terms of growth, and therefore profit growth. Secondly, I believe that the bear market will be heralded by increasing geopolitical risk, but of a different nature to the last 12 months. In the last 12 months, geopolitical risk did not really matter to markets because people, investors, esteemed that the geopolitical risks and events were not economically significant enough. I think that is probably over. In the next year, I think the geopolitical risks will rise. China gets worse and more belligerent. Whatever the next US president is, it will essentially reduce the support, already inadequate support for Ukraine, and make the Ukrainian situation worse and more threatening to Europe, which matters globally economically. So if you take those two factors, that the gaps do not get bridged, that the dreams do not get repeated, and that the cost of geopolitics will become economically significant and relevant and a threat to markets, that is why I believe that next year could be a surprise in terms of not more of the same, but a bear market. Thank you. And please go to our website. I will list the address in the comments below. But verbally, it is www.quantumstrategy.org, and we would welcome you. Thank you.